The global financial system sits on a ticking time bomb that most people don't even know exists. We're talking about derivatives, complex financial instruments that have grown to an unfathomable size. Back in 2008, when the world watched Lehman Brothers collapse and the entire banking system teeter on the edge of oblivion, everyone focused on subprime mortgages and toxic assets. But there was something far more dangerous lurking in the shadows, something that made those mortgage-backed securities look like child's play. The derivatives market had already ballooned to over $600 trillion by 2008. To put that in perspective, that's more than 8 times the entire global economy. 8 times. Every factory, every farm, every business, every home, every asset on planet Earth multiplied by 8. And somehow, this massive web of interconnected bets was supposed to make the financial system safer. That's what they told us. That's what the banks believed. And in 2008, we almost found out just how catastrophically wrong they were. But here's the thing that should keep you awake at night. That bomb never actually exploded. The government stepped in, pumped trillions into the system, and essentially kicked the can down the road. They didn't defuse the bomb. They just delayed the timer. And now, as we head into 2026, that timer is running out, and the derivative market has grown even larger, even more complex, and even more dangerous than it was 18 years ago. Let me take you back to understand how we got here. Derivatives started as a simple concept. A farmer wants to lock in the price of his wheat before harvest. A buyer wants to guarantee they can purchase that wheat at a known price. They make an agreement, a contract for a future transaction. Simple. Logical. It makes sense. This kind of derivative, called a futures contract, has existed for centuries and serves a genuine economic purpose. But then Wall Street got involved, and what started as a tool for farmers and businesses to manage real risk transformed into a casino where banks bet on everything imaginable. They created derivatives based on interest rates, currency movements, stock prices, commodity prices, weather patterns, and even the likelihood that other derivatives would fail. They built derivatives on top of derivatives on top of derivatives, creating a house of cards so tall and so unstable that nobody, not even the people who created them, fully understood what would happen if one card fell. The real danger comes from something called counterparty risk. When you buy a stock, you own something tangible. When you deposit money in a bank, there are regulations and insurance protecting you. But derivatives are different. A derivative is essentially a bet between two parties. If one party can't pay up, the other party loses everything. And in the interconnected world of modern finance, these parties are usually banks, and those banks have thousands of these agreements with other banks, creating a web so complex that if one major institution fails, it could trigger a cascade of failures across the entire system. In 2008, we saw a glimpse of this when AIG, one of the world's largest insurance companies, nearly collapsed. AIG had sold credit default swaps, a type of derivative that acts like insurance against bond defaults, to major banks around the world. When the housing market crashed and those bonds started failing, AIG suddenly owed far more money than it could possibly pay. If AIG had been allowed to fail, it would have taken down Goldman Sachs, Morgan Stanley, and potentially every major bank in America and Europe with it. The government had no choice but to bail them out with $182 billion of taxpayer money. That wasn't a solution. That was a band-aid on a severed artery. After 2008, regulators promised reform. They passed the Dodd-Frank Act in America, implemented new rules requiring banks to hold more capital, and created clearinghouses to add transparency to derivative trades. Politicians gave speeches about how they'd fix the system, how it could never happen again. But here's the uncomfortable truth. The derivative market didn't shrink. It grew. According to the Bank for International Settlements, the notional value of outstanding derivatives reached $600 trillion again by 2023, and by some estimates, it's now approaching $700 trillion or more. The bomb got bigger, not smaller. You might wonder why banks keep creating these instruments if they're so dangerous. The answer is simple. Profit. Derivatives generate enormous fees and trading profits for financial institutions. A bank might make millions on a single complex derivative transaction, and the people creating these products get paid huge bonuses based on short-term profits, not long-term risk. There's a fundamental misalignment of incentives. The people taking the risks aren't the ones who will suffer if those risks blow up. By the time the house of cards collapses, they'll have already collected their bonuses and moved on. Now let's talk about what's different in 2026. Why is the situation more dangerous now than it was in 2008? Several factors are converging to create what many experts believe could be the perfect storm. First, interest rates have been on a roller coaster. After years of near-zero rates following the pandemic, Central banks rapidly increased rates to combat inflation, then began cutting again as recession fears mounted. Every time interest rates move dramatically, the value of interest rate derivatives changes, and there are more interest rate derivatives than any other type. We're talking about contracts worth hundreds of trillions of dollars that become profitable for one party and devastating for another with each rate change. Second, government debt has exploded globally. The United States national debt has surpassed $35 trillion. Japan's debt-to-GDP ratio exceeds 250%. European nations are drowning in debt. China's local government debt is spiraling out of control. When governments are this leveraged, their ability to bail out the financial system in a crisis is severely limited. In 2008, governments could still borrow and print money without immediate catastrophic consequences. Today, any attempt to repeat those massive bailouts could trigger a sovereign debt crisis, currency collapse, or hyperinflation. Third, the banking system is actually more concentrated now than before 2008. The big banks didn't get broken up. They got bigger. They absorbed the failing banks, and now an even smaller number of institutions control an even larger share of the derivative market. JP Morgan Chase alone holds derivatives with a notional value exceeding $50 trillion. If something goes wrong at one of these mega banks, the ripple effects would be instantaneous and global. Fourth, we've seen warning signs that the system is cracking. In March 2023, Silicon Valley Bank collapsed in the second-largest bank failure in American history. First Republic Bank failed shortly after. Credit Suisse, a 167-year-old Swiss banking giant, had to be rescued through a forced merger. These weren't tiny regional banks. These were significant institutions, and their failures revealed that the supposedly reformed banking system still had fundamental weaknesses. None of these banks failed primarily because of derivatives, but each failure sent shockwaves through the derivative markets as counterparties suddenly wondered who else might be in trouble. The derivative that poses the greatest systemic risk today is probably the interest rate swap. These contracts allow parties to exchange fixed interest rate payments for floating rate payments or vice versa. Banks, corporations, and governments use them to manage their exposure to interest rate changes. The problem is that the market for interest rate swaps is absolutely massive, with a notional value approaching $400 trillion. As interest rates have swung wildly, the mark-to-market value of these swaps has created enormous hidden losses at financial institutions around the world. Here's how it works. Imagine a bank enters into an interest rate swap agreement when rates are at 2%, agreeing to pay a fixed rate in exchange for receiving a floating rate. Then rates jump to 5%. Suddenly, that bank is locked into paying below-market rates while receiving above-market rates, creating a huge paper profit. But on the other side of that trade is another institution with a huge paper loss. If that institution can't meet its obligations, the bank with the paper profit suddenly has a real loss. Multiply this by thousands of transactions across hundreds of institutions, and you begin to see the problem. The opacity of these markets makes the risk even worse. Despite regulations requiring more transparency, much of the derivative market still operates in the shadows. Clearinghouses now handle a larger portion of trades, which theoretically reduces counterparty risk, but it also concentrates risk at the clearinghouses themselves. If a clearinghouse fails, it could be catastrophic. And we've already seen stress in these systems. In 2020, during the COVID market panic, the London Metal Exchange had to halt trading and reverse trades after a massive short squeeze in nickel futures threatened to bankrupt multiple members. If that can happen in a relatively small market like nickel, imagine what could happen in the interest rate or credit derivative markets. Another terrifying derivative is the credit default swap, the same instrument that nearly destroyed AIG. These are essentially insurance policies against bond defaults. If you own corporate bonds and worry the company might go bankrupt, you can buy a credit default swap that pays you if default occurs. Sounds reasonable, right? The problem is that you don't actually need to own the bonds to buy the insurance. It's like buying fire insurance on your neighbor's house and then having an incentive to burn it down. Speculators can buy unlimited amounts of credit default swaps, creating a situation where the total insurance exceeds the value of the underlying bonds by many times. As we move into 2026, corporate default rates are rising. Years of cheap money allowed zombie companies, businesses that barely generate enough profit to cover their interest payments, to survive. Now, with higher interest rates and a slowing economy, these companies are starting to fail. Each default triggers payouts on credit default swaps, and if defaults accelerate, we could see a cascade effect similar to what happened with mortgage defaults in 2008. The sellers of these swaps might not have the capital to cover their obligations. There's also the issue of collateral. Derivative contracts typically require parties to post collateral to secure their obligations. As market conditions change, the amount of collateral required changes too. In a crisis, institutions might suddenly need to come up with billions of dollars in additional collateral immediately. If they can't, they default on their derivative obligations, triggering more collateral calls at other institutions, creating a death spiral. This is exactly what nearly happened to hedge funds in March 2020 when the government bond market seized up. Only massive intervention by the Federal Reserve prevented a complete meltdown. The geopolitical situation adds another layer of risk. Financial sanctions have become a standard tool of international policy. When Russia invaded Ukraine, Western nations froze Russian central bank assets and cut Russian banks out of the SWIFT payment system. This was unprecedented, and it sent a clear message to countries around the world. Your dollar reserves, your euro holdings, your connections to the Western financial system can be weaponized against you. In response, nations are diversifying away from dollar-based systems, and this fragmentation of the global financial system makes the derivative market more dangerous because counterparty risk increases when trust decreases. China represents a particularly acute risk. The Chinese financial system is opaque, heavily indebted, and deeply interconnected with the global economy. Chinese banks and corporations are counterparties to countless derivative contracts with Western institutions. If China's property bubble finally bursts completely, if local governments can't service their debts, if Chinese banks face a wave of defaults, the losses would ripple through the derivative markets globally. And unlike in 2008, when Chinese growth helped pull the world out of recession, China itself is now part of the problem. Let's talk about what a derivative crisis would actually look like for ordinary people. In 2008, millions lost their homes, their jobs, their savings, and their pensions. The government prevented complete collapse, but the recovery took years and many never fully recovered. A derivative crisis in 2026 could be worse because the response options are more limited. If major banks fail and derivatives contracts collapse, the immediate effect would be a freeze in the financial system. Credit cards might stop working. ATMs might run out of cash. Businesses couldn't process payments. International trade could halt because letters of credit, which guarantee payment between parties who don't know each other, depend on the banking system functioning. The government would likely try to intervene, but this time the political will for massive bailouts is questionable. After 2008, there was enormous public anger about bailing out the banks while ordinary people suffered. Occupy Wall Street, the Tea Party movement, and populist uprisings across Europe were all partly reactions to the perception that the system favors the wealthy and powerful. If politicians try to bail out the banks again, they might face even more intense backlash. But if they don't bail out the banks, the entire system could collapse. Central banks would probably resort to even more extreme measures than in 2008. We might see unlimited quantitative easing, where central banks buy up assets to inject money into the system. We might see negative interest rates taken to new extremes. We might see direct intervention in markets to prop up prices. But these actions come with consequences. The more money central banks print, the more they risk destroying confidence in the currency itself. Inflation could spiral out of control. People might lose faith in money altogether and flee to hard assets like gold, silver, or even cryptocurrency. The psychological impact cannot be understated. In 2008, people were shocked because they believed the system was fundamentally sound. They thought regulations and safeguards would prevent disaster. This time, many people are already skeptical. They've watched wealth inequality grow as asset prices soared while wages stagnated. They've seen multiple boom-bust cycles. They've witnessed bank failures, market crashes, and pandemic disruptions. If the derivative bomb detonates, it might not just be a financial crisis. It could be a crisis of legitimacy for the entire economic system. Some experts argue that the system has actually become more resilient. They point to higher capital requirements for banks, stress testing, clearinghouse reforms, and better risk management. They say the notional value of derivatives is misleading because most contracts offset each other, and the actual risk is much smaller. They note that banks survived the pandemic shock and the recent bank failures without systemic collapse, demonstrating the reforms worked. These arguments aren't entirely wrong, but they miss the fundamental problem. The issue isn't whether the system can handle normal stress. It's whether it can handle an extreme tail event, a perfect storm of simultaneous problems that overwhelm all the safeguards. The derivative market is built on the assumption that counterparties will always be able to meet their obligations, that governments will always be able to intervene if necessary, that markets will remain liquid even in crises. But these assumptions can break down. In fact, they've broken down before and only emergency measures prevented total collapse. What happens when those emergency measures can no longer work? There are signs that smart money is preparing for trouble. Hedge funds have been buying put options, betting on market declines. Gold prices have been climbing. Some investors are moving assets offshore, diversifying across jurisdictions and currencies. Wealthy individuals are buying farmland, a tangible asset that holds value even if financial markets collapse. These aren't actions of people who believe the system is stable. The technology sector adds another dimension to the risk. Algorithmic trading now dominates financial markets, with computer programs executing trades in milliseconds based on mathematical models. These algorithms interact with each other in complex ways that humans can't always predict or control. In a crisis, algorithms might simultaneously try to sell, overwhelming the market and accelerating the crash. We've seen flash crashes where markets briefly plunged before recovering, but imagine a flash crash that doesn't recover because it triggers a cascade of derivative failures. What should individuals do to protect themselves? The honest answer is that if the derivative market truly collapses, there's no perfect shield. But there are sensible precautions. First, understand that cash in a bank is only as safe as the bank itself and the government's ability to back the deposit insurance. Diversifying across multiple banks reduces risk. Second, tangible assets like real estate, commodities, and physical goods hold value even when financial assets collapse, though they come with their own risks. Third, having some emergency savings in physical cash can be valuable if electronic payment systems fail temporarily. Fourth, reducing personal debt makes you less vulnerable to financial disruptions. Fifth, developing skills and relationships that have value in any economic system provides security that transcends financial markets. The broader society needs to have difficult conversations about what we want our financial system to be. Do we want a system where the profits go to a small number of institutions and individuals while the risks are socialized across all taxpayers? Do we want a system where banks can create nearly unlimited amounts of synthetic risk through derivatives? Do we want institutions that are too big to fail, too complex to regulate, and too interconnected to resolve? These aren't just technical questions. They're fundamental questions about what kind of economy and society we want. Some economists have proposed radical solutions. Break up the big banks so no single institution threatens the entire system. Ban certain types of speculative derivatives that serve no real economic purpose. Require derivatives to be traded on exchanges with complete transparency. Impose strict limits on leverage. Create a public banking option so people aren't entirely dependent on private institutions. These ideas face fierce resistance from the financial industry, which argues they would reduce efficiency and competitiveness. But the efficiency of a system that periodically destroys trillions of dollars of wealth and requires massive government bailouts is questionable. The clock is ticking. Every day that passes with this massive derivative overhang is a day we're gambling that nothing will go wrong. And the odds are not in our favor. History shows that complex systems eventually face shocks that exceed their design parameters. The financial system is a complex system, and we've deliberately made it more complex, more leveraged, and more fragile than ever before. The question isn't whether a derivative crisis will happen. It's when and whether we'll have learned enough from 2008 to handle it better this time. As we approach 2026, multiple stress factors are aligning. Geopolitical tensions are rising. Government debts are unsustainable. Interest rates remain volatile. Corporate defaults are increasing. Public faith in institutions is declining. The derivative market remains enormous and opaque. The ingredients for disaster are all present, simmering together, waiting for a catalyst. That catalyst could be anything. A major bank failure. A sovereign default. A war. A pandemic. A cyber attack. A natural disaster. Or it could be something we haven't even considered, an unknown that catches everyone by surprise. The $600 trillion derivative bomb that everyone worried about in 2008 never exploded because governments defused part of it and buried the rest deeper underground. But now that buried bomb is leaking and the ground above it is starting to crack. Those who've been paying attention can see the warning signs, hear the ticking, feel the tremors. The question is whether enough people will recognize the danger in time to do something about it, or whether we'll sleepwalk into a crisis that makes 2008 look like a minor correction. What makes this moment so critical is that we're running out of tools. Interest rates are already low by historical standards, limiting how much central banks can cut them in a crisis. Government debts are already so high that massive new borrowing might trigger confidence crises. The public is already angry about inequality and bailouts, limiting political options. We've already used the emergency playbook and we're still sitting on the same bomb, just with a shorter fuse. The derivative market exists in a strange space between the real economy and pure abstraction. These contracts represent claims on future cash flows, bets on future events, insurance against future losses. But they're traded, valued, and leveraged as if they were as real as factories and farms. When the notional value of derivatives exceeds the global economy by 10 times, we've entered a realm where financial fiction threatens to overwhelm physical reality. If everyone simultaneously tried to settle their derivative positions, to convert these abstract contracts into actual money and assets, the impossibility would become immediately apparent. There simply isn't enough real wealth in the world to back up all these claims. This is the fundamental fraud at the heart of the modern financial system. We've created a mountain of claims on wealth that doesn't exist, and we've built institutions and careers and fortunes on the assumption that we'll never have to actually settle all these claims simultaneously. It's a sophisticated version of musical chairs, and right now the music is getting quieter, the players are getting nervous, and there aren't enough chairs for everyone. The people who understand this, the insiders who know how the system really works, are quietly preparing. They're moving assets, restructuring portfolios, buying insurance in the form of options and gold. They know that when the music stops, when the derivative bomb finally detonates, there won't be time to react. The cascade will happen faster than anyone can respond. Banks that were solvent one day will be insolvent the next. Counterparties that were reliable will default. Markets that were liquid will freeze. The interconnected nature of modern finance means that failures propagate at the speed of light, through fiber optic cables connecting trading floors around the world. Understanding this reality is the first step. The derivative market isn't some abstract concern for finance professionals. It's a threat to everyone's savings, jobs, and economic security. The $600 trillion house of cards sits above our heads, and we've all been living underneath it, hoping it won't fall. But gravity eventually wins. Complex systems eventually fail. And when this system fails, when the derivative bomb detonates, the explosion will reshape our economic reality in ways we're only beginning to imagine. The choice we face isn't whether to prevent the crisis. It might already be too late for that. The choice is whether we'll prepare for it, whether we'll demand changes that make the system more robust, whether we'll build alternatives that don't depend on this fragile architecture. Because one thing is certain, the $600 trillion bomb that didn't explode in 2008 is still here, still ticking, and the timer is running out.